Hi, if you're a practice owner that's looking at perhaps selling your practice, or if you're an associate doctor looking at buying one, then you need to understand how practices are evaluated based on the profitability and what's called a multiple. If this is of interest to you, stay tuned. That's what's coming up. Hi, Dr. Joel Parker here with the Standing Ovation Practice. Listen, I spent 17 years in private practice, 15 of those in an ownership position, and I've spent the last 20 years plus consulting business owners, practice owners, managers just like yourselves on how to run not good but great standing ovation practices. This week, we're part of the Valuation series. I want to talk to you about the basics, kind of practice valuation 101, whether you're buying or selling, so you've got the concept of what goes in to getting a fair price for your practice, something that's not too lean for you, something that's not too expensive for the seller, something in that wonderful, to use the expression again, that Goldilocks zone of just right. Okay, so the basic principles are here that practices are valued on multiples of the profitability of the profit. Okay, now as we went over in the profit loss series, the profit is that leftover money at the end of the year before the tax write-offs come in for that final submission. So it's the leftover money in the practice. What happens, that's also called the EBITDA, the earnings before the interest are deducted, before taxes are paid, before the depreciation on the tangible assets, the equipment, or the amortization on the goodwill. So it's that basic leftover profit on the end of the year that is then taken, and it is times by what's called a multiple. And a multiple is just a number that you're using to say the profit on this practice was $1 million this year. The multiple is 6, therefore the practice is worth $6 million, something like that. Okay, probably 30, 40 years ago, practices were really bought on gross income, kind of like 1 year's gross income. What a lot of evaluators like to do, and I should just make something here, there are official licensed evaluators within our veterinary profession. They've gone to do courses. They're very professional. They're most likely part of the Valuation special interest group as part of the Vet Partners Association, and you can contact them through vetpartners.org. And if you need a practice evaluated or you're looking at selling yours, you've got people there that can do that for you. Okay, very, very important. So it is an official thing, but the basics are looking at probably 3 years of profit, prorating the most recent year, less proration on the last year, and then less on that third year out, and then getting a kind of prorated profitability for those 3 years, and then depending on the style of practice, timesing it by that multiple. And that's going to get you into the ballpark. That's why this profit loss statements is so important to understand what the EBITDA is, the earnings before the interest deductions, before you pay taxes, before the depreciation deduction on the equipment and assets, tangible assets, or the amortization on the goodwill. That's basically what's going to go on. Or if you're looking at a practice to buy, I would get 3 years of profit loss statements, 3 years of tax submissions, plus I'd want to get a lot of other data in terms of the KPIs in the practice. But this is the basic mindset that goes on. Now, when you look down here, I've got private sale versus corporate. Private sales are done more on what's that leftover EBITDA, and the typical multiples are 4 to 5. You know, and I think a lot of us in private practice would love to do a private sale to one of our associates or a new, shiny DVM coming in, but it really depends on what your finances are and whether you need or don't need that extra $1 to 2 to 3 to $4 million that a corporate sale can bring in. So let's talk about that, okay? So what you'll find here is that if you've got a practice style that is a one doctor practice and you're doing upwards of about 125 million gross revenue, you're going to see that your multiples are going to be of your EBITDA, of your profit, at about 4 to 5. Okay, and that's decent. So if you've got, let's say, $1 million practice and you've turned it up to 20%, then you could get a multiple of 5, 20% profit, you get a multiple of 5, and that would give you a practice sale of $1 million. Okay, however, the problem with that is it's highly dependent upon you being in the practice as the owner. And as you can see down here, as you add DVMs, the practice becomes less owner dependent. The income goes up above that 1.2, and you can see over here that the multiples start to jump up to 8 to 9. What makes a higher selling practice is it's less owner dependent, meaning that you as a practice owner are doing 10, 15 hours of clinical work a week, and maybe you're going to fill in for the other relief doctors, and you've got 2 to 3 other doctors that are doing the work. That's going to increase your value. As well as you take it up into the $1 to $2 to $3 to $4 million of gross revenue, that's going to increase your value as well. Okay, it's going to take you up into these multiples here. There's a couple other things that cause corporate buyers to be interested, and that is no lab contracts, and that you've got a good source, a repeated source of finding associate doctors. Okay, because everybody is struggling in the profession to find associate doctors, and if you've created that standing ovation practice, like I've been working with practices over the last 20 years, then you will start to attract attention in your veterinary community, and you will have repeatedly associate doctors that want to work for you. Okay, that's all part of the standing ovation practice. So what gets these higher multiples of 16s? Standing ovation practices that are running relatively owner independent. Okay, guys, so that's all I've got for you this week on practice valuation. It's all done on multiples of the EBITDA, the leftover profit, really, kind of averaged over, prorated over that 3-year period. Corporate buyers will pay more, especially if there's multiple doctors and there's a higher gross income. Okay, that's all I got for you this week. If you enjoyed this content, please hit the like button down below, hit the subscribe button, turn on your notifications, tell your friends about it, and if you feel like it, leave me a comment down below. I'd love to hear from you. Thanks so much for watching. I'll see you next time.